Altria stock is one that I've continuing to buy week after week, day after day. I believe there is a ton of upside with this undervalued company. We're going to take a look at the performance of Altria. We are also going to touch upon some news that has recently come out with New Zealand's U-turn on the smoking ban, which we discussed recently when looking into these companies. We're also going to look at Altria's dividend safety, run through their updated financial metrics and discuss that important safety. We're going to look at some of their earnings that has come out in comparison to 2022. We want to understand whether the institutions are continuing to buy this company as it has fallen. We also want to compare them on a total return basis to some companies that we do believe to be similar, such as BTI, Imperial Brands, Philip Morris and UVV. And as always, with their latest earnings, we will look at their updated balance sheet, their total cash versus total debt to see the health of this company and the general performance, their total revenue top line, as well as their bottom line net income. And as always, we will put them through our stock valuation model, getting to our intrinsic value and acceptable buy price given that investor margin of safety. So the stock is down around 9% year to date. It did come all the way down to $39 and it has picked up slightly. So it is still trading towards the mid to lower end of the 52-week range. And it does offer a very strong yield of 9.45%. Now, investors who have been holding the company over the last 10 years would be up only really 11%. And even though that doesn't really include those dividends reinvested, it's not the greatest return. And we can see it hit its peak quite some time ago at around $77. So let's understand whether this company is a great buy now, whether we can expect the share price to double or triple over the next 10 years. And with that high yield, see how high that yield on cost can grow 15, 20, 25% in the years to come. So let's jump on straight away, starting with the institutions, and we can see around 59% institutional ownership. And over the last 12 months, we see around 4.4 billion worth of shares sold by the institutions, but a significant number more, 55 billion, being bought by these institutions over the same period. So they are definitely loving this company and the price and the value it has right now. And we can see in Q2, they bought around 51 billion worth of shares and sold around 871 million. Now, do remember, just because the institutions are buying hand over fist, we do not copy them as investors, and we always do our own due diligence. Now, let's take a quick look at some comparisons versus BTI, Japan Tobacco, and a few others. Now, total return year to date, so it does include those dividends reinvested, you would be down on MO around 2.88%. And as we can see, it isn't the greatest return on any company. But do remember that past performance is never an indicator for future performance. And when we extend that to the last 5 years, as always try and look at extended periods where possible if you have the data available. They are up around 14 to 15%. Again, not the greatest, and we're not using this as a benchmark for future performance, but always something just to include in your analysis to understand. Now, when we take a look at their latest earnings from September 2023 that came out not too long ago, they did miss on both the earnings per share and top line. They expected 130 on the earnings per share, came in at 128, so 2 cents short of analyst estimates. And in terms of the top line, whilst 5.43 billion was expected, again, they did come down 5.28 billion. On top of that, when we do analyze the September 23 versus September 2022, on the top line, they were down around 2.49%. However, the bottom line, they were up 867%, as well as their profit margin up considerably. But do note their operating income was down, and we can see their net change in cash was positive. Now, as always, we do need to understand the industries of companies we invest in. And with this tobacco industry, we do see consumers moving away from nicotine products to essential other products, but it doesn't necessarily mean this isn't something that Altria Group can move into. And it is one, in my personal opinion, I do see them making moves into the industries and services that will effectively increase their income, which we have touched upon on many episodes prior. Now, top line, what we typically like to see from essential companies, 3 to 7% year on year. December 2018, 19.6 billion. December 2022, 20.7 billion. So we can see, whilst there has been growth over the last 5 years. It isn't what we like to see and is a slight worry or something to consider if it isn't keeping up with inflation. On a more granular level, we do, however, see increases from 2018 to 2021 before a decrease to 2022, and then to trading 12 months is showing us that it looks to be around the 2022 figures, so minimal growth, but we will analyze the 23 figures when we release them or when they are released. So it is okay, it's nothing major, nothing great, and it is something to consider and something that we do expect from this industry, and we'll touch upon the last 10 years movement shortly too. 6.9 billion reported in bottom line net income in 2018, 5.8 billion in 2022, so it has dropped in fact over the last 5 years, and we do see from 2018 to 2019 a drop, and then it rebounds nicely before dropping and then picking up, and we again see the trading 12 months in fact looking to be very strong at around 8.8 billion, so we would expect to see a nice increase on the bottom line. So again, whilst we do see the top line not growing much, we do see the similar story on the bottom line with the inconsistencies, but we can see a nice jump to that net income based on the trading 12 months. Now, in terms of the balance sheet, total cash versus total debt for a quick health check, 1.3 billion cash on their balance sheet in 2018, 1.5 billion from their latest report. So they are holding a marginally larger amount of cash than they did 5 years ago, around 10%. And when we compare that to their total debt, what we in actual fact see is it has remained fairly flat from 25.7 billion to 25.1 billion. So they've paid off around 600 million, which in the grand scheme of things in relation to the amount of debt isn't that much. But we will look at their net debt to EBITDA when we look at their dividend safety. Now, one thing to note, if you are new to the channel or you weren't realizing what was happening in the industry, New Zealand had effectively had a smoking ban for a generational ban. And now when we do take a look, they've effectively done a U-turn on that. And UK had followed that, and what it's essentially saying is this is bad news for Rishi Sunak, who is the current PM for the UK government, as they were also planning to do something similar. So very briefly, what this essentially says, New Zealand's new coalition government has announced that it will scrap the plan to usher in the generational smoking ban that it had initially had. What this would have done would have steadily lifted the legal age for buying cigarettes from 2027, so basically stopping anyone who was born after 2008 from purchasing them. And it does say they are not even going to give this, what they call a strange experiment, a chance. And there's a few reasons, which does make sense when you think about it. They do want to avoid essential myriad of problems, one of them being having to ID people in their 50s and 60s, some of who would be allowed to buy cigarettes and some wouldn't, depending on when they were born. And on top of that, what that effectively has is a two-tier society of adults, where adults in the ages of, say, 50 and 60, some of you or your friends would be able to buy cigarettes and some wouldn't. So that is something to consider. It was a hot topic that we did discuss in one of the previous episodes, where we did say that New Zealand were bringing this in, the UK were looking to follow. Now New Zealand have scrapped this. It will be interesting to see how this essentially moves for the UK and Rishi Sunak as the Prime Minister or current Prime Minister. And one thing that was quite interesting from this article, and this does just relate to the UK, when we do take a look, the kids who are essentially rejecting cigarettes has increased. So people who did start to smoke was around over 50% in the 1980s to now we can see around 12% in the 2020s. So something just to bear in mind there. Two things: one, whether or not you believe that the industry as a whole is dying, and two, whether or not this U-turn or the ban that has effectively been scrapped by New Zealand will affect companies such as MO, such as BTI and PM and so on. So now let's jump into the dividend safety. We see a borderline safe score here of 55, market cap 73 billion, so it is a large cap company. Now when we take a look at some recessionary metrics, they did increase the dividend during the 07-09 recession. They did have an incredible negative 50% recession sales, which was well below the average growth of companies in the S&P 500, which was effectively negative to a smaller degree, but they did far outperform the S&P, down negative 20% to the S&P's negative 55. Now, dividend growth, it is actually one thing that I do quite like from Mo or Altria Group, one of the reasons why I do invest. As we can see, yes, you are getting a 4.3% increase from August 2023, which is what they effectively target as management team. They are looking for high, mid, single-digit increases, so mid to high effectively. So what this effectively means is that you are locking in an increase of inflation around 4% this year, whilst receiving a yield, as we saw at the beginning, of 9.45%, which is positive in my opinion. Last 5 years, 8%. Yes, the last 20 years lower than inflation, but we are looking as a forward perspective rather than the past. Now, they are also a dividend king, having paid increasing dividends over the last 50 years or more. And when we look at dividend yield theory, it states effectively that a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation. Do bear in mind, though, we don't look at any of these models in isolation. Again, the same with the forward PE of 8.2, sitting below the 5-year average of 9.7. Another sign of undervaluation. And we can see the consumer staples PE significantly higher, 18.7 versus 8.2. Now, for the newer viewers, do bear in mind that the 52-week low is never a signal for undervaluation. Likewise, 52-week high is never a signal for overvaluation. Now, in terms of the earnings and free cash flow, you know that we ignore the earnings. It is susceptible to manipulation by management through accounting. So on the free cash flow for tobacco companies, below 85%, as they do pay the majority of their earnings as dividends. So what we can see is for the large part, it has been around that 85% or lower. In fact, the last 4 to 5 years, it's been below 85%, and 2023 is expected to be around that 80% level. So again, in my opinion, positive. Right now, there are no reasons to be worried about the dividend safety. Likewise, free cash flow per share is growing, maybe not as consistent as we would like, but 212 in 2013, 502 in 2022, more than doubled, although it is expected to come down slightly in 2023. Now, sales growth, this is an issue with companies like the tobacco companies in the industry. It is industry specific, whether or not an industry is growing or dying or how they are looking to mature their business. But 3 to 7% is what we like to see, but we can see for the majority of the years, they are struggling to even keep up with inflation. So in real terms, their top line is decreasing, and we do see a 2% decrease in 2022. Now, total shares, if you wanted to know numerically, it's gone from 17.7 to 20.7. And one thing that is nice to see, they have bought back around 10% of their shares over the last 10 years, returning excess cash to investor pockets. Now, in terms of ROIC, incredible numbers here. We always look for 10% or more for the majority of businesses, as it means the management are effectively allocating their capital. And it has been well above 10% every single year. The last 2 years in the 40s, very positive to see. Does give me faith in management so far. Operating margin, incredible, around 50% on average over the last 10 years. Free cash flow margin, again, very, very strong numbers. So there aren't really any worries personally in the way the business is being run. Net debt to EBITDA, this is important. It does relate to that dividend safety, effectively telling us the number of years it would take the company to pay off all of their debt net of cash on hand. It was quite high in 2018, but still below the 3 we aim for as a maximum, and it has come down since then to 1.85, with 2023 expected to be roughly similar. So that is essentially the dividend and financial metrics for Altria Group, and now we can jump into the valuation. As always, if you do enjoy the content, value is being provided. Do smash that like button, hit the subscribe and bell so you are continually notified of these videos as they drop. And if you do want to grab a copy of the intrinsic calculator to get to your acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. So we have the stock price, the ticker symbol MO, the earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bonds. Remember, the higher the yield, the lower the intrinsic value. So this gives an intrinsic value of essentially $46, and we can see there's around 10% upside to the current trading price, and within that 52-week range, showing signs of undervaluation currently. Do remember, though, we're not looking at any of these models in isolation and drawing our conclusions towards the end. Now, when we take a look at the multiples valuation model, we have companies in a similar sector in size: Philip Morris, Universal, British American Tobacco. We have the stock price, earnings per share. P multiple, we get the average, multiply that by the earnings per share to give a stock price of $61. Now that is far above the 52-week high and well above the current trading price. In fact, 50% upside, showing some nice undervaluation in the current market for Altria Group. We then move on to the dividend discount model, where we have our yearly dividends, and we have a nice growth rate around 4%, so you are keeping in line with inflation whilst getting a very nice high yield. Forward looking, I have gone very, very conservative at 1%. Remember, if you grab a copy of the model, you can put your own figures through based on your own estimates, judgments, and thesis. So this gives a DDM price of $56. Again, some very, very strong upside to the current trading price and above the 52-week high, showing signs again of severe undervaluation. We then move on to the DCF model, where we have our free cash flows year on year. Average growth rate around 11%. Now, I have gone a lot more pessimistic at keeping it flat, in fact, below analyst estimates. And with that discount rate, we get the present value of future free cash flows, terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get a DCF price of $58. Again, above the 52-week high, showing signs of severe undervaluation in the current market. Now, the intrinsic value is just the average of the 4 models that we have run through. And again, if you do enjoy the content, value is being provided. Do smash that like button, hit the subscribe bell. It does help the channel grow, pushes out the content to more investors. And now jumping in, we see the intrinsic value at $55 with the current price around $41. Now, margin of safety, we typically start with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. Now, this is very subjective depending on the investor, the way they see the tobacco industry moving, and just the macroeconomic conditions. So those looking at 15%, you would be looking at a buy up to $47. Those looking at 20% up to $44. Those looking at 25%, roughly at the current trading price. So you are locking in a 25% margin of safety. And if I am honest, when we did run through a lot of those models, a lot of the factors and numbers we put in were very conservative. So in my opinion, you are getting a very strong 25% margin of safety. And what Wall Street are saying over the next 12 months, they do believe the price to increase by just under 20%. Not near enough where our intrinsic value is, but they see some strong upside. So based on our estimates and judgments, you are getting a 25% margin of safety with what Wall Street believe to be around 15 to 20% upside. As always though, do let me know your thoughts in the comments below. Is Altria a company you invest in? Is it one you've recently sold out of? And how do you see the tobacco industry moving forwards? Do you think this will inevitably die? Do you think that U-turn on the New Zealand ban will affect the other countries such as the UK from having those bans and putting them in place? And just your general thoughts on the Altria Group. As always, if you've enjoyed the content, smash the like button, hit the subscribe and bell. If you want to grab a copy of the intrinsic value calculator to get to your own acceptable buy price of companies in your own portfolio, or even if you want to run through Altria again based on your own estimates, do click on that pinned comment below. As always, have a great day, catch you on the next episode, and take care.